You can spot a bad real estate investment in under 5 minutes. 5 minutes, that's all it takes. And you don't need spreadsheets, you don't need a broker, you don't even need to walk inside the building. You just need 3 things: location, the number of bars, security bars on the windows, and some basic math. After doing hundreds of millions of dollars in real estate deals, I can promise you, if you miss any of these 3, the deal is dead before you even start. Let me show you exactly what to look for. Hey, and real quick, if you like what you're seeing, hit that subscribe or that share button. It genuinely helps the channel and YouTube push it out to more people just like you. And make sure to check out the links in the description if you want some free learning opportunities beyond this. Here's the thing, most bad deals don't sneak up on you. They're obvious, but only if you know what you're looking for. New investors tend to get emotional. They fall in love with the photos. They believe the broker's pitch. They want the deal to work so badly that they'll ignore the warning signs from a mile away. These 3 rules I'm about to show you, location, the bars, security bars on the windows, and the famous DSR will save you from most bad investments before you waste your time underwriting them. Stay with me, because the last one, the 1.25 DSR, has saved me and investors in disasters above anything else. Look at the surrounding neighborhood. If you want to spot a bad investment quickly, don't look at the building, look at what surrounds it. Strong properties sit in strong neighborhoods. Here's some positive signs. You want that multifamily apartment building around single family homes, and or at least abutted to on 1 or 2 sides of it. You want it around schools and parks, clean, well-kept streets, pride of ownership. You want it around churches, banks, other institutions like that. Some red flags: too much industrial, auto shops, nightclubs, heavy commercial traffic, liquor stores, 7-Eleven, stuff like that right next door to it. The neighborhood determines the tenant base. And if your tenant base determines your returns, here's the bottom line. If that neighborhood wouldn't attract the tenant that you want, neither will your building. The next test is simple. Drive the street and count the number of security bars on the homes and the windows in that neighborhood. The bars equal crime, break-ins, low stability, higher turnover. More bars means more repairs, more evictions, more headaches, more operational chaos. If the block looks like the buildings are preparing for an invasion, your expenses will look like an invasion too. My rule is simple. If I can drive that street and there's more bars on the windows than not, I'm out. You don't need analytics. You don't need crime reports. You don't need data scientists. The street tells you everything. The truth is instant. And if you wouldn't let your wife or your kids walk down that street alone, why in the world would you invest your money there? And now the single most important rule of them all. If the property does not hit a 1.25 debt coverage ratio or greater on day 1, walk away. Not after the renovations, not after rent increases and all the value add stuff you're going to do, from day 1. Why? It gives you a buffer for vacancies, loss to lease, economic losses, people not paying their rent. You got delinquency issues, repairs, rate fluctuations, market changes. Your net operating income, your NOI, must be at least 25% greater than the debt payment every single month. If it's not, you're not investing there. You're not hoping. Hope is not a strategy. The bank won't even let you do it anyways because they're not going to give you the loan properly. The biggest fear most new investors have is losing money, right? One bad deal doesn't just cost you money, it costs you confidence. It stalls momentum. It takes you years to recover. But knowing these 3 rules, location, number of security bars on the windows, and the DSCR, removes 80% of the risk before you even start underwriting. This is how you move fast, smart in real estate. So if you like this, do me a favor, drop a comment down which of these 3 rules surprised you the most and that you have some questions on. And if you want to learn how to underwrite deals like this, analyze them, the neighborhoods, and scale into multifamily, 10 to 30 unit apartment buildings, check out the links in the descriptions as well. I've got deeper resources totally free for you there. So hit the like, subscribe button, and I will see you on the next one. Take care and happy investing.